Before we begin, please note that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided in this video does not constitute financial or legal advice. Auto insurance rates, coverages, and company availability vary significantly based on your individual circumstances, location, and other factors. You should always conduct your own research and consult with a qualified professional before making any financial decisions or purchasing an insurance policy. You are being ripped off. Right now, as you're sitting there, your car insurance company is likely charging you hundreds of dollars more than they should, and they are banking on the fact that you'll never notice. How do I know? Because the entire system, the one that's been in place for nearly a century, is fundamentally broken. It's a relic from a time before smartphones, before GPS, before we had the technology to know the difference between a grandma driving to the grocery store and a street racer treating the highway like their personal drag strip. The old guard insurance giants, the ones with the funny commercials and the catchy jingles, they're still using ancient math. They look at your age, your zip code, your credit score, and maybe the color of your car, and they lump you into a giant bucket with thousands of other people. If someone in your bucket gets into a fender bender, guess what? Your rates go up. If you live in a neighborhood they flagged as high risk, your rates go up. If you had a late credit card payment 3 years ago, believe it or not, your rates can go up. It's a system where you, the safe, responsible driver, are forced to pay for the mistakes of the worst drivers on the road. It is, without a doubt, one of the biggest, most accepted financial scams in modern America. And the cost of this outdated system is staggering. The average American driver overpays for car insurance by an estimated $400 every single year. $400. That's a new set of tires. That's a weekend getaway. That's a significant chunk of your holiday shopping budget, just vanishing into the pockets of a multi-billion-dollar corporation that still thinks it's 1985. They call it the loyalty penalty. It's a dirty little secret in the industry where they slowly, almost imperceptibly, raise the rates on their most loyal long-term customers, knowing that the hassle of shopping around is enough to keep most people from leaving. They reward your loyalty with a higher bill. It's insane. But what if I told you a revolution is happening right under our noses? A rebellion against the old way of doing things. A wave of new, smart, tech-savvy insurance companies has emerged, and they are poised to completely dismantle the old system. These aren't your grandpa's insurance companies. They don't care about your credit score. They don't care about broad, unfair stereotypes based on your zip code. They care about one thing and one thing only: how you actually drive. Over the course of this presentation, we are going to pull back the curtain on these disruptive new players. I'm going to show you exactly who they are, how their groundbreaking technology works, and how they could potentially save you hundreds, if not thousands of dollars a year. We're going to arm you with the knowledge you need to stop overpaying and start paying what you actually deserve for car insurance. The core idea that powers this revolution is called telematics, or usage-based insurance. It's a simple yet profoundly fair concept. The price you pay should be directly related to the risk you represent. If you're a safe driver, you should pay less. A lot less. And the first company that truly took this idea and ran with it, building their entire business model around it, is a name you need to know: Root Insurance. Root didn't start in a stuffy boardroom with a bunch of executives in suits. It started out of pure frustration. The founders looked at the industry and saw the same injustice we've been talking about. They saw good drivers being punished financially, forced to subsidize the reckless ones. So they asked a radical question. What if we could base a person's insurance rate almost entirely on their actual driving behavior? What if we could throw out all the other biased, irrelevant factors and create a price that was truly fair? Their solution was brilliant in its simplicity. They decided to create the ultimate test drive. Instead of filling out a long form about your past, you download the Root app on your smartphone. You sign up and then you just drive. For about 2 to 3 weeks, you go about your normal life. You drive to work, you pick up the kids, you go to the store. And while you do, the app runs quietly in the background, using the sensors already built into your phone, the accelerometer, the gyroscope, the GPS, to understand your driving habits. Now, what is it actually looking for? It's measuring the key indicators of a safe driver. First, braking. Are you a smooth, gradual braker who anticipates stops? Or are you constantly slamming on the brakes at the last second? Second, turning. Are your turns controlled? Or are you taking corners like you're in a high-speed chase? Third, and this is a big one, focus. The app can detect if you're handling your phone while the car is in motion, a massive indicator of a distracted, high-risk driver. It also looks at the times of day you drive. Consistently driving between midnight and 4 a.m., statistically the most dangerous hours on the road, will count against you more than a daytime commute. After a few weeks of collecting this data, Root's algorithm crunches the numbers and generates your personal driving score. And here's the game-changing part. If your score is good enough, they offer you a quote based on your real-world driving. And if your driving is just too risky, they won't even offer you a policy. They are explicitly and unapologetically an insurance company for good drivers only. This is the secret sauce. By weeding out the worst drivers from their insurance pool, their overall risk plummets. When they have fewer claims to pay out, they can pass those massive savings directly on to their customers, the good drivers. The potential savings are not just a few bucks here and there. Root claims that their best drivers can save up to 52% compared to their previous insurance. Let's put that in perspective. The average annual cost for full coverage car insurance in the US is floating around $2,000. A 52% savings on that is over $1,000. $1,000 back in your bank account every single year just for driving the way you already do. That's a mortgage payment. That's a plane ticket to Europe. It's a transformative amount of money. So who is this for? Obviously, it's for people who are confident in their driving skills. If you're a patient, defensive driver who avoids heartbreaking and keeps your phone down, you are the ideal Root customer. It's fantastic for people with short commutes or who don't drive much late at night. It can also be a financial lifesaver for younger drivers or people with a less than perfect credit history. The old system would punish them with sky-high rates, but Root gives them a chance to prove they're responsible behind the wheel and be rewarded for it. Now I know what you're thinking. This sounds great, but what's the catch? The first and most obvious concern for many is privacy. You want me to install an app that tracks my every move? No thank you. It's a valid concern, but let's be realistic. Most of us already have apps like Google Maps, Waze, or even social media apps that are tracking our location data 24/7. Root is transparent that they only use the driving data from the test drive period to calculate your rate. They're not selling your location data to marketers or tracking where you go for any other reason. They need that data for the one purpose of seeing if you're a safe driver. For many, the trade-off of sharing a few weeks of driving data for a potential savings of $1,000 a year is a no-brainer. The second concern is, what if I have a bad day? What if I have to slam on my brakes once to avoid an accident? Root's system is designed to look at the big picture. It's analyzing hundreds of miles of driving over several weeks. One or two isolated incidents of heartbreaking won't tank your score. The algorithm is looking for patterns of behavior. Is aggressive driving your exception or your rule? It's the consistent day in day out habits that determine your final rate. Root fundamentally changes the relationship between you and your insurer. It's no longer an adversarial relationship where you're just a line item on a spreadsheet. It's a partnership. They are literally betting on you to be a safe driver. And when you are, both of you win. But this model, as powerful as it is, relies entirely on your smartphone. What if you're not comfortable with that? What if you want the savings that come from a personalized rate, but you want it based on something even simpler? Not how you drive, but just how much you drive. For the millions of Americans now working from home, or for retirees, or for anyone who just doesn't put a lot of miles on their car, there's another company that has perfected this pay-per-mile model, and it's saving low-mileage drivers an absolute fortune. That company is called Mile Auto, and their entire business model is built on a single, powerful, and almost ridiculously simple idea. If you drive less, you should pay less. It sounds like common sense, right? But for a century, the auto insurance industry has largely ignored this. They've charged you a flat rate, a massive premium based on broad, impersonal categories. Your age, your zip code, your credit score, the car you drive. They might ask for your estimated annual mileage, but let's be honest, that's just a guess. Whether your car sits in the garage for 25 days out of the month or you're a door-to-door salesman racking up 1,000 miles a week, your premium has been stubbornly, infuriatingly fixed. You're subsidizing the high-mileage drivers. The retiree who drives 3,000 miles a year pays a similar rate to the supercommuter who drives 30,000. It's a system that has felt fundamentally broken for millions of people. Mile Auto looked at this broken system and decided to shatter it. They didn't just want to tweak the model. They wanted to flip it on its head. Their solution? A pay-per-mile insurance policy that is so straightforward it's brilliant. Here's how it works. You pay a very low monthly base rate. Think of this as your parked coverage. It covers your car against things like theft, vandalism, or a tree branch falling on it while it's sitting in your driveway. This base rate can be incredibly low, sometimes as little as $30 or $40 a month, depending on the usual factors. Then, you pay a few cents for every single mile you actually drive. That's it. The base rate plus your per mile cost is your entire bill. Now, you might be thinking, okay, that sounds like other telematics programs I've heard of. What's the big deal? The big deal, the game-changing innovation, is how they track your miles. This is where MileAuto truly separates itself from the pack and addresses a huge concern for many drivers: privacy and hassle. Most pay-per-mile or usage-based programs require you to plug a device, often called a dongle, into your car's OBD2 port. This device tracks not just your miles but often your speed, how hard you brake, the time of day you drive, and your exact location via GPS. For many people, that feels like a massive invasion of privacy. It's like having the insurance company sitting in your passenger seat, judging your every move. It also drains your car battery and can be a technical pain. MileAuto's founders recognized this fear. They understood that people want savings but not at the cost of their personal privacy. So, they developed a system called mVerity. It's a patented technology that requires no tracking device, no app constantly running on your phone, no Big Brother. All you have to do is take a picture of your car's odometer with your smartphone once a month and send it to them. That's the entire process. A simple photograph. They use that photo to verify your mileage, calculate your bill, and you're done. It's secure, it's simple, and most importantly, it's completely non-invasive. They don't know where you're going, how fast you're driving, or if you're stopping for a late-night taco run. They only know one thing: the number of miles you drove. And that's the only thing they believe should matter when it comes to usage-based pricing. Let's put this into real-world numbers so you can see the staggering impact. Let's say your traditional insurance policy is $150 a month. You work from home now, and you only drive about 400 miles a month to the grocery store, the gym, visiting family on the weekend. With MileAuto, your base rate might be, say, $40, and your per-mile rate might be 6 cents. So your monthly bill would be the $40 base rate, plus 400 miles times 6 cents, which is $24. Your total bill? $64. You've just gone from paying $150 a month to $64. You're saving over $1,000 a year, without changing a single thing about your lifestyle. You're just finally being charged a fair price for how much you actually use your car. The obvious question then is, what's the catch? What happens if I take a long road trip? This is a brilliant question, and it's one that MileAuto has already solved. They have a daily mileage cap. This is crucial. On any given day, you're only charged for a maximum number of miles, usually 250 miles, though in some states it's as low as 150. So, if you decide to drive 500 miles to visit your cousin in one day, you don't get hit with a massive bill. You only pay for the first 250 miles. The other 250 miles that day are essentially free. This gives you the best of both worlds. Incredible savings for your everyday low-mileage life, and the freedom to take that long summer road trip without the fear of a punishing insurance bill waiting for you when you get back. This model is a revolution for a massive and growing segment of the American population. Think about it. The millions of people who now work remotely, retirees who no longer have a daily commute, college students who live on or near campus and only use their car to go home for the holidays, families with a second or third car that's only used for occasional errands. For all these people, the traditional insurance model has been a ripoff. MileAuto is offering them an escape hatch, a way to align their costs with their actual behavior. The company itself is still relatively new and expanding its footprint across the United States, currently available in a growing number of states like Arizona, California, Illinois, and Texas, with more on the way. They've focused on a lean, tech-first approach that keeps their overhead low, and they pass those savings directly on to the customer. They're not spending billions on celebrity-filled Super Bowl ads. They're spending their resources on refining their technology and offering the most competitive rates possible for their target audience. It's a quiet revolution, happening one odometer photo at a time. They are proving that you don't need invasive, complex technology to create a fairer insurance product. Sometimes the most powerful innovations are the ones that prioritize simplicity and respect for the customer. But this focus on mileage, as powerful as it is, only solves one part of the puzzle. It's perfect for the low-mileage driver, but what about everyone else? What about the person who does have to drive 50 miles to work every day? Are they just stuck with the old, unfair system? What if you're a fantastic driver, you never speed, you never tailgate, you've never even had a parking ticket, but you're being punished with sky-high rates simply because you live in a crowded zip code? Or you're under 25? Or your credit score isn't perfect? These are factors that have very little to do with how you actually behave behind the wheel. The industry has used them for decades as crude proxies for risk. But what if a company could throw all of those old-school metrics out the window? What if they could use the powerful sensors already in your pocket to build a complete picture of your driving DNA and base your rate almost entirely on that? Well, there's another disruptive new company doing exactly that, and it's forcing the entire industry to question the very definition of a good driver. This company is called Root Insurance, and their entire philosophy is built on one radical, almost offensively simple idea. Car insurance should be based on how you drive. Not your age, not your credit score, not your marital status, and not the neighborhood you live in. Just your actual real-world driving habits. They believe that the traditional way of pricing insurance is fundamentally broken, using what they call proxies for risk instead of measuring risk itself. Think about it. Why does a low credit score mean you're a bad driver? Doesn't. It means you've had financial trouble. The industry's logic is that people with lower credit scores are statistically more likely to file claims. But that's a correlation, not a cause. You could be the safest driver on the planet, a true saint behind the wheel, but if your credit took a hit because of medical bills or a lost job, the big insurance companies would label you a high-risk client and charge you an astronomical premium. Root looked at this and said, "That's not just unfair, it's bad business." So how do they fix it? They make you audition. They call it the test drive. When you sign up, you download their app, and for the next few weeks, your phone becomes your co-pilot, your judge, and your jury. The app runs quietly in the background, using the sensors already in your smartphone, the GPS, the accelerometer, the gyroscope, to paint a hyper-detailed picture of your driving habits. It's building that driving DNA we just talked about, and it's watching everything. Are you a smooth operator? Or do you slam on the brakes at every yellow light? That's heartbreaking. A huge indicator of tailgating or not paying attention. Do you take corners like you're on a racetrack? Or are your turns gentle and controlled? That's aggressive cornering. What time of day are you driving? Cruising at 2 p.m. on a Tuesday is statistically way safer than navigating the bar closing rush at 2 a.m. on a Saturday. But here's the metric that's truly a game changer: focus driving. The app can tell if you're handling your phone while the car is in motion. We all know distracted driving is a plague on our roads, responsible for thousands of deaths every year. Traditional insurance has no way to measure this directly. They can only look at your ticket history. Root measures it in real time. If you're someone who can't resist checking a text at a red light or scrolling through a playlist while on the highway, their algorithm sees it, and your score plummets. They are directly measuring the single biggest behavioral risk in modern driving. After a few weeks of this data collection, the test drive is over. The algorithm crunches the numbers and gives you a score. And based on that score and that score alone, they offer you a quote. Or they don't. And this is the most disruptive part of Root's entire model. If the test drive reveals that you are, in their eyes, a bad driver, someone who brakes hard, takes fast turns, and uses their phone, they will flat out refuse to insure you. Let me repeat that because it's so contrary to how the industry works. They will deny you coverage. Their business is not built on insuring everyone and just charging the risky people more. It's built on creating an exclusive pool of verifiably good drivers. By kicking out the riskiest 30 to 40% of applicants, they dramatically lower the overall risk of their customer base. And when you have fewer claims to pay out, you can offer much lower prices to the good drivers who are left. It's a powerful and self-reinforcing loop. The good drivers get rewarded with rates that can be hundreds, sometimes even thousands of dollars cheaper per year, because they are no longer subsidizing the claims of the reckless drivers who got a discount because they had a good credit score. This directly attacks the very foundation of old-school insurance. For 100 years, the model has been based on demographic profiling. Where do you live? A dense urban zip code with a higher crime rate means a higher premium, even if you keep your car in a locked garage and have never had a scratch on it. How old are you? If you're under 25, you're automatically considered a massive risk, even if you're more responsible than a 45-year-old going through a midlife crisis with a new sports car. What's your marital status? Married people are statistically safer. It's a system built on stereotypes and generalizations. Root argues that these are relics of an analog past. We now have the technology to replace these crude statistical proxies with precise individual-level data. Why guess who the good drivers are when you can simply measure it? Of course, this raises two massive questions. First, the privacy concern. Is it creepy that an app is tracking your every move? For some people, absolutely. The idea of a private company knowing your location, your speed, and your habits is a non-starter. But for a growing number of people, especially younger generations, it's a simple value exchange. We already give our data to Google for better maps, to Amazon for faster shopping, and to social media for entertainment. The idea of giving your driving data to an insurance company in exchange for a potentially massive discount seems like a pretty fair trade, especially when the alternative is paying more based on factors you can't control, like your zip code. The data is encrypted, it's not sold, and it's only used to calculate your rate. You are in control of the transaction. The second question is, what if you're a good person but just not a great driver according to their algorithm? Maybe you live in a city like Boston or Los Angeles where hard braking is a survival skill, not a sign of aggression. This is the model's biggest challenge. The algorithm is the ultimate authority, and it can lack context. A hard brake to avoid a child running into the street is seen by the app as the same as a hard brake because you were texting and looked up at the last second. The system isn't perfect, but Root's argument is that, over thousands of miles, your true driving style will emerge. The patterns will become clear, and the occasional necessary hard brake will just be a drop in the ocean of data from your otherwise safe driving. For the millions of people who have been penalized for years by an unfair system, it's a risk they're willing to take for a chance at a fair price. The shockwave this behavior-based model sent through the industry is undeniable. Suddenly, the giants like Progressive with its Snapshot program and State Farm with Drive Safe and Save, which had been treating these telematics programs as optional discount add-ons, were forced to take them seriously. Root proved that a massive segment of the market was not only willing to be monitored, but they were demanding it. They wanted to be judged on their merits, not their demographics. This forced the entire industry to accelerate their tech development and reevaluate their century-old pricing models. The very definition of risk was being rewritten, not in a boardroom, but in the real-time data streams coming from millions of smartphones. So, tracking your driving behavior is one powerful way to disrupt the system. It's about creating a fair assessment of your past and present actions. But what about the future? What if your insurance could do more than just reward you for driving safely? What if it could actively help you avoid an accident in the first place? It's one thing to have a silent observer in your pocket grading your performance. It's another thing entirely to have an active co-pilot, a guardian angel powered by AI, that's looking out for you on the road, and even coaching you to become a better driver. The next wave of insurance isn't just about pricing risk, it's about preventing it. And one new company is putting a smart camera on your dashboard to do exactly that. This company is called Nexar, and they're not really selling insurance. They're selling certainty. They're selling the end of the he said, she said argument forever. At the heart of it is a deceptively simple piece of hardware, a smart dual-facing dash cam. One lens points forward, capturing the road in crystal clear HD. The other points into the cabin at you. And I know what you're thinking. A camera watching me drive? No thank you. Hold that thought, because by the end of this you might see that little camera not as a spy, but as the single best witness you could ever have on your side. Let's paint a picture. It's a Tuesday afternoon. You're stopped at a red light listening to a podcast, thinking about what to make for dinner. Suddenly, bam, a jolt from behind. You're thrown forward. Your heart is pounding. You get out, and the driver of the car that hit you is already out of his vehicle, pointing at you, yelling that you slammed on your brakes for no reason, that you rolled backward into him. It's your word against his. There are no other witnesses. You know what happened. He knows what happened. But now you have to convince a claims adjuster, maybe even a cop, and your story is just a story. The stress, the paperwork, the phone calls, the fear of your rates going up for something that wasn't your fault. It's a nightmare. Now let's rewind and play that same scenario with the Nexar camera on your dash. The moment of impact happens, and the camera's G-force sensors instantly register the collision. It automatically saves the video clip, starting from 20 seconds before the impact to 20 seconds after, and securely uploads it to the cloud. But here's where the magic happens. It isn't just a video file. Nexar's artificial intelligence gets to work immediately. It analyzes the footage from both cameras. It pulls the telemetry data from your phone's GPS, your exact speed, your location, the force of the impact. It creates an entire data-rich, AI-generated collision report. This report is like something out of a CSI episode. It shows a map of the incident. It shows your speed leading up to the stop. It shows you were completely stationary for 12 seconds before the impact. It shows the other car approaching from behind, and it calculates their speed at the moment of the crash. It's an airtight, undeniable, objective reconstruction of reality. While the other driver is still thinking up his story, you've already tapped a button in the Nexar app and sent this entire, bulletproof report directly to your insurance company. The conversation is over before it even begins. The claim is processed in days, not weeks. Your deductible is waived. Your rates don't move an inch. The nightmare is gone. That is the power of putting a digital witness on your dashboard. But what about that inward-facing camera? Let's talk about the elephant in the car. The idea feels intrusive, feels like Big Brother. And Nexar understands this, so they've built it with privacy at its core. The footage is your property. It's encrypted. It's only uploaded to the cloud if a significant event, like a crash, is detected. You control who sees it, but its real purpose isn't to watch you. It's to protect you. It can detect distracted driving. If you're looking down at your phone for too long, a gentle, non-judgmental alert might sound. It's not reporting you to anyone. It's just a reminder. A digital tap on the shoulder to keep your eyes on the road. For parents with a 16-year-old who just got their license, this feature isn't intrusive. It's priceless peace of mind. It's a coach, not a cop. The system's intelligence goes far beyond just crashes, though. This is where it starts to feel like you have a personal security detail for your car. Let's say you're parked at the grocery store. Someone swings their door open and leaves a nasty dent in your passenger side. Or worse, someone backs into your bumper and just drives off. Normally you'd come back, see the damage, and feel that sinking feeling of knowing you're on the hook for the repairs. With Nexar's parking mode, the camera sensors detect the impact, wake up, record the event, and send an alert with the video clip straight to your phone before you've even left the checkout line. You now have the make, model, and, most importantly, the license plate of the car that hit you. You've gone from a victim to being in complete control of the situation. This network of cameras creates something even bigger. Every Nexar camera on the road is anonymously mapping and sharing real-time road conditions. If a car a half-mile ahead of you slams on its brakes for a stalled vehicle in the lane, your app can give you a heads-up before you can even see it. It can warn you about a massive pothole that other Nexar users have driven over. It's creating a crowdsourced safety net, a digital shield that extends beyond just your own car. You're not just a driver anymore. You're part of a connected, protected community. So how does this all circle back to insurance and saving you money? It's simple. Insurance is a business of guessing. Companies use your age, your zip code, your credit score, and your driving history to make an educated guess about how likely you are to cost them money. A camera like this replaces the guess with a fact. Insurance companies that partner with vision-based systems like Nexar's can offer massive discounts because they aren't guessing anymore. They have proof. They see that you're a safe driver. They know that if you are in an accident, the claim will be settled quickly, cheaply, and without fraud because the video doesn't lie. The savings aren't just on your premium. The real value is in avoiding the one big one. The one accident that wasn't your fault, but costs you your $1,000 deductible and jacks up your rates for the next 3 years. That one incident can cost you thousands. This system acts as your financial firewall against the bad luck and bad drivers of the world. It's a shift in mindset. You're no longer just buying a policy that pays out after something bad happens. You're investing in a system that actively works to prevent the bad thing from happening in the first place, and if it does, ensures the outcome is fair and swift. We've seen how telematics tracks the how and the when of your driving. Now, vision-based systems are adding the what and the why. They see the context. They see the other driver run the red light. They see the deer jump out onto the road. They provide the complete story. This is a monumental leap forward. We've gone from passively tracking a vehicle's data to actively seeing the world through its eyes. But what's the next logical step in this evolution? We've put a black box in the car. We've put a smart camera on the dash. What happens when the insurance isn't an app or a device you add on, but is built directly into the very soul of the car from the day it rolls off the assembly line? What if the car is the insurance company? This isn't a what-if scenario from a sci-fi movie. This is happening right now in your neighbor's driveway. The car is becoming the insurance company. And this fundamental shift is being driven by one thing: data. Your new car, especially if it's electric, is less a collection of mechanical parts and more a supercomputer on wheels. It has hundreds of sensors, cameras, GPS, accelerometers. It sees, feels, and records everything. And the companies that build these cars are realizing that the data they collect is potentially more valuable than the steel and glass they sell. They have a direct, unfiltered, real-time fire hose of information about the single most important factor in any car insurance equation: you, the driver. And no one is pushing this revolution harder or faster than Tesla. When Tesla announced its own insurance product, the legacy giants of the industry probably rolled their eyes. Another tech company trying to play in the big leagues. But they weren't just slapping their logo on a policy underwritten by someone else. They were rebuilding the very concept of insurance from the ground up, using their unique, native access to the car's data. The core of their entire model is something called the safety score. Forget your credit score, your zip code, or your age. Tesla says those are just crude proxies for risk. Why guess how risky you are based on demographic data when they can know with pinpoint accuracy how you actually drive? The safety score is a number from 0 to 100, calculated in real time based on your actual driving behavior, as measured by the car's internal sensors. And this score directly and dramatically impacts your monthly premium. Get a score of 98? You could see your rates plummet by 40, even 60% compared to a traditional insurer. Get a score of 85? You might end up paying more. So what is this all-powerful score actually measuring? It boils down to 5 key behaviors that Tesla's data has identified as the strongest predictors of a future collision. First, forward collision warnings per 1,000 miles. Your car is constantly scanning the road ahead. If it thinks you're about to rear-end someone and flashes a warning, that dings your score. It's a measure of your attentiveness and reaction time. Second, hard braking. This is defined as the car detecting a strong negative change in velocity. It's not just about stopping short. It's the car saying, you had to slam on the brakes because you likely weren't anticipating the flow of traffic. Third, aggressive turning. Again, measured by the car's G-force sensors. A sharp, high-speed turn suggests you're either in a hurry or not in full control. Both are red flags. Fourth, unsafe following distance. Using its forward-facing cameras and radar, the car measures the time gap between you and the car in front. Spend too much time tailgating and your score drops. It wants to see that safe 3-second buffer. And fifth, a fascinating one, forced autopilot disengagement. If you're using autopilot and the system determines you're not paying attention, maybe you're looking at your phone, it will give you audible and visual warnings. Ignore them, and the system will lock you out for the rest of an entire drive. The car is literally punishing you for being an irresponsible babysitter of its own technology, and that punishment is reflected in your insurance premium. Imagine a tale of 2 drivers. Let's call them Mike and Sarah. They live on the same street, drive the same model Tesla, and have identical driving records with their old insurance company. Mike is a classic point A to point B commuter. He leaves a safe following distance, coasts to a stop, and treats turns like a gentle arc. His safety score hovers around 99. His Tesla insurance premium is a jaw-droppingly low $60 a month. Sarah, on the other hand, is always in a bit of a rush. She's not a reckless driver, not by a long shot. But she accelerates quickly from lights, follows a little closer in traffic to prevent people from cutting in, and sometimes takes corners a bit sharper than necessary. She might have to brake hard once or twice a week when someone unexpectedly stops in front of her. Her safety score fluctuates between 88 and 92. Her premium? It's $150 a month. Same car, same street, same traditional risk profile. But in this new world, she pays 2.5 times more than Mike. This is the power and the peril of data. Tesla has an almost unfair advantage. A traditional insurer using a telematics app on your phone or a plug-in device is getting a fuzzy, second-hand picture. The phone's GPS might be a little off. Its accelerometer can't distinguish between the car turning and you just picking up your phone. It's an estimate. Tesla isn't estimating. It knows. It has the raw, unfiltered data from the car's central nervous system. It knows the exact steering wheel angle, the precise pressure on the brake pedal, the exact speed of the wheels. This is the difference between watching a grainy security video and having a high-definition, first-person view of the event. The upside is obvious and incredibly compelling. It's the ultimate meritocracy. For the first time, your insurance bill is a direct reflection of your actions behind the wheel, not a demographic box you've been placed in. It creates a powerful feedback loop. You see your score drop, you know exactly why, and you can consciously change your behavior to improve it and save money. The potential for this to make our roads safer is enormous. But there's a dark side, a very dark side. Who decides what safe is? A Silicon Valley algorithm? What happens if you have to slam on the brakes and swerve aggressively to avoid a deer that just jumped into the road? You saved your life and prevented a massive claim, but the algorithm just sees hard braking and aggressive turning, penalizes you. It lacks context. And what about the weather? Driving in a blizzard in upstate New York requires a completely different set of inputs than cruising down a dry freeway in Arizona. Does the algorithm know the difference? They say it does, but the system is opaque. The calculations are a black box. You're being judged by a secret formula you can't see and can't appeal. And then there is the inescapable question of privacy. Your car is now a 24/7 surveillance device reporting directly to your insurance company, which also happens to be the company that made your car. It knows you left work late. It knows you went to the gym. It knows you stopped for fast food on the way home. It knows every trip, every route, every stop, every single day. You are trading your privacy for a discount. For many, that's a bargain they're willing to make. For others, it's a dystopian nightmare. And make no mistake, this is not just a Tesla experiment. This is the future of the entire industry. General Motors has OnStar Insurance, which uses data from its own built-in OnStar system to set rates. Ford has its own program, in partnership with insurers, using the car's embedded modem to track driving habits. Rivian, Lucid, every new electric vehicle manufacturer is at its core a data company. It is inevitable that they will all follow suit. Why would they let a third-party company like Progressive or Geico profit from the rich data their own cars are generating? The very definition of a car company is changing before our eyes. They are no longer just manufacturers of physical goods. They are becoming vertically integrated mobility and data service providers. The car, the loan, the maintenance, the software updates, and now the insurance all under one roof. All powered by the data you generate just by living your life. We've moved from the insurance company putting a spy in your car to the car company being the spy. But this is still just the beginning. Right now, the car is judging you based on your actions in a vacuum. It sees your braking, your turning, your speed. But it's still largely blind to the world around it. What happens when that changes? What happens when the car can not only see the road but can talk to it? What happens when it can communicate with every other car, every traffic light, and every pedestrian smartphone in a citywide digital mesh? The concept of an accident as we know it begins to crumble, and with it, the entire 100-year-old foundation of auto insurance. This fundamental shift creates a mind-bending legal and financial problem, a liability labyrinth. Think about it. Today, if there's a two-car collision, it's relatively simple. The police show up, they assess the scene, they look at the evidence, and fault is assigned, usually to one driver or the other. Your insurance company and their insurance company battle it out. But in a world of fully autonomous, interconnected vehicles, who's the driver? Who is at fault when a level 5 autonomous vehicle, one with no steering wheel or pedals, makes a split-second ethical decision to swerve, avoiding a child but hitting a parked car? Do you blame the owner of the vehicle, who was in the back seat reading a book? That seems absurd. Their only action was pressing a button on an app to summon the ride. Do you blame the car manufacturer, the Fords and Teslas of the world? They built the hardware after all. But what if the hardware was perfect and the problem was in the software? So, do you blame the company that wrote the millions of lines of code for the autonomous driving system? Maybe. But that code runs on an operating system which was likely developed by another company entirely. And what about the sensors? The car's eyes and ears? What if the LiDAR unit, made by a third-party supplier, failed to detect an object because of a rare solar flare event that momentarily interfered with its laser? Or what if the 5G network that connects all the vehicles had a millisecond of lag at the exact wrong moment, delaying a critical warning from another car by just enough time to make a crash unavoidable? Suddenly, you're not just suing a driver. You're potentially suing the network provider, like Verizon or AT&T. You might be suing the city itself for a malfunctioning smart traffic light that failed to communicate its status. The list of potential defendants explodes. It's no longer a simple car accident. It's a complex technological failure, and the search for liability becomes a forensic investigation into a digital ghost in the machine. This is the reality that is completely short-circuiting the legacy insurance industry. Their entire business model is built on assessing individual human risk. They look at your age, your gender, your credit score, your driving history, where you live, and what you drive. They put all that data into an actuarial table and spit out a premium. But in this new world, your personal driving skill is completely irrelevant. It doesn't matter if you're a 17-year-old with a lead foot or a 70-year-old with a perfect record. You're not driving. The algorithm is. So, the very concept of a personal auto insurance policy begins to evaporate. Why would you need one? The risk is no longer tied to you, the individual. The risk is tied to the system, the product, the technology itself. And this is where we see the emergence of a completely new insurance paradigm and the companies that are quietly building the future. The insurance of tomorrow won't be a direct-to-consumer product you shop for on Geico's website. It will be a massive, complex commercial policy. It will be a form of product liability and cybersecurity insurance, purchased not by you, but by the car manufacturers, the software developers, and the fleet operators. The cost of this insurance will simply be baked into the price of the car, or more likely, into the monthly subscription fee you pay for the transportation as a service that the vehicle provides. Your insurance premium becomes invisible, bundled into the cost of mobility, just like the cost of the steel or the battery. This is where you need to start paying attention to companies you've likely never heard of. Forget the ones with the catchy jingles for a moment. Look at a company like Coop Technologies. They are an insurance technology company focused exclusively on the risks of autonomy and robotics. They are not asking how well you drive. They are asking entirely different questions. They are performing what they call technical underwriting. They want to see the software's source code. They want to know its update frequency and patch history. They analyze the failure rates of the specific sensors and processors used in the vehicle. They assess the security of the cloud platform where the driving data is processed. They are, in essence, ensuring the machine's ability to perform, not the humans. Their risk models aren't based on speeding tickets and DUIs. They're based on things like mean time between failures for a specific LiDAR sensor, or the cyber resilience of the car's operating system against hacking. This is a quantum leap from the old model. An insurer like Coop or the future companies that follow its lead will have a team of software engineers, data scientists, and cybersecurity experts, not just claims adjusters and underwriters. They will be technology companies first and financial services companies second. When an accident happens in this future, the process is completely different. There's no emotional, contradictory testimony from witnesses. There is only data. The vehicle's black box, or more accurately, its continuous data stream to the cloud, will provide a perfect millisecond by millisecond record of what every sensor saw, what every line of code decided, and what every mechanical component did. The investigation will be an audit of a forensic data trail. The insurance company will use AI to analyze terabytes of data from the crash to determine the root cause. Was it a software bug in the path planning module? A hardware fault in the braking actuator? A data transmission error from the city's infrastructure? Once the fault is identified, the claim is paid out from the massive policy held by whichever entity was responsible. If it was a software bug, the software developer's insurance pays. If it was a faulty sensor, the hardware manufacturer's insurance pays. For you, the passenger, the process is seamless. Your vehicle is replaced or repaired, your medical bills are covered, all without you ever having to file a claim with your insurance company, because you don't have one. The giants of the system, the Teslas, the Waymos, the Apples, will handle it all on the back end. It's a simpler, more efficient world for the consumer. But it also centralizes risk in a way that is both powerful and terrifying. The risk is no longer distributed among millions of individual drivers. It's concentrated in the hands of a few dozen massive technology and manufacturing companies. And while their systems may be 99.999% safer than human drivers, eliminating millions of accidents a year, the accidents that do happen will be of a completely different nature. They won't be random fender benders. They will be systemic. A single bad line of code in a software update pushed overnight to 1 million vehicles could, in theory, create 1 million simultaneous failures the next morning. A single cybersecurity breach could turn an entire fleet of autonomous taxis in a city into a weapon. This creates a new, even more frightening question. We've figured out how to insure against the failure of the machine. But how do you insure against the malicious, intentional corruption of that machine? What does insurance even look like when a hacker doesn't just steal your credit card number, but takes control of the 1-ton steel vehicle you're traveling in at 70 miles per hour? The game changes completely. The risk is no longer about accidents or even system failures. It's about warfare, digital warfare, and that requires an entirely new breed of insurer, one that thinks less like an actuary and more like a counterintelligence agency. So what does that look like? What does an auto insurer that operates like a spy agency actually do? Well, for starters, their underwriting process is completely alien to what we know today. They're not just asking for your driving record and your zip code. They're asking for the patch level of your car's operating system. They're analyzing the security protocols of your home Wi-Fi network that your car connects to every night. They're offering you premium discounts not for being a safe driver in the physical world, but for being a safe user in the digital one. Are you using two-factor authentication for your car's mobile app? That's a 5% discount. Did you complete their optional online module on identifying phishing attempts disguised as vehicle service alerts? Another 3% off. Your policy isn't just a document. It's an active, symbiotic security partnership. Their telematics device, if they even need one separate from the car's built-in modem, isn't just tracking speed, acceleration, and hard braking. It's a full-time cybersecurity sentinel. It's monitoring data packets, looking for anomalous traffic. It's watching for unauthorized connection attempts from unknown devices. It's essentially a digital guard dog for your vehicle. And when it barks, their central command is alerted instantly. This isn't about punishing you for taking a corner too fast. It's about protecting you from a threat you can't even see. Let's paint a picture. Imagine a family, the Millers, on a cross-country road trip. They're in their brand-new, top-of-the-line electric SUV, a marvel of modern engineering. They're 2 days into their trip, somewhere in the vast, empty plains of Nebraska. The kids are asleep in the back, and the car is in its advanced driver assist mode, humming along the interstate at a steady 75 miles per hour. Suddenly, the interior lights start flashing erratically. The infotainment screen, which was just showing the route to their hotel, goes black. Then it flickers back to life with a single ominous icon: a skull and crossbones. The climate control blasts Arctic cold air, then switches to suffocating heat. The sound system, moments ago playing a gentle podcast, erupts with static at maximum volume. Panic sets in. The driver, Mr. Miller, tries to take manual control. He grabs the wheel, but it's rigid, unresponsive. He slams his foot on the brake pedal, but nothing happens. The car continues to cruise at 75 miles per hour, a 2.5-ton metal prison. Then a synthesized voice fills the cabin, cutting through the static. Your vehicle is now under our control. It says, cold and robotic. Do not attempt to interfere. A payment of $10,000 in cryptocurrency must be transferred to the address on your screen within the next 30 minutes. If you fail, or if you attempt to contact the authorities, we will disengage the safety protocols. Everyone in that car knows what that means. The car would simply drive itself off the road at full speed. This is the new nightmare. Not a drunk driver or a patch of black ice, but an anonymous, faceless attacker 1,000 miles away, holding your family's life for ransom. So what do the Millers do? In a traditional insurance scenario, they'd be completely on their own. Let's say they somehow survive. They call their big, household name insurance company. The agent on the other end would be utterly baffled. So you're saying your car was stolen? While you were in it. And it was a computer hacker. The claim would be stuck in underwriting purgatory for months. The insurer's lawyers would argue it's not a collision. It's not theft in the traditional sense. It might even fall under an act of war or cyber-terrorism exclusion in the fine print of their policy. The Millers would be left with a traumatized family, a potentially bricked $70,000 car, and a bill for a $10,000 ransom they probably couldn't pay. But the Millers are insured by our new breed of company, the cyber-first insurer. Mrs. Miller, her hands shaking, presses the emergency button on the car's console, which has been hardwired to bypass the hack software and connect directly to the insurer's incident response center. Within 2 seconds, a human voice comes through, calm and professional. This is the Paladin Group threat response. We have your vehicle's location and diagnostics. We see the active intrusion. Do not panic. We are with you. The voice isn't a customer service rep. It's a trained cyber incident commander. As she's talking to the family, reassuring them, a team of ethical hackers is already at work. They aren't filing paperwork. They are deploying countermeasures. They use a secure, backdoor channel built in collaboration with the car manufacturer, a condition of getting the vehicle approved for their insurance in the first place. They launch a digital counteroffensive. They flood the attacker's connection with junk data, isolating the car's critical systems, steering, braking, propulsion, from the compromised infotainment and comfort controls. Inside the car, the family hears the commander's voice again. Okay, we've firewalled the drive systems. The attacker is locked out from anything that controls the car's movement. Mr. Miller, you should have manual control back in now. He grabs the wheel and this time it responds. He taps the brakes and the car begins to slow down. The sense of relief is so overwhelming it's physically painful. While he pulls the car safely onto the shoulder, the cyber team is still at work. They're not done. They are now actively tracing the attack, gathering data for law enforcement. They are purging the malicious code from the car's system and uploading a security patch in real time. Within 10 minutes of the initial attack, the car is fully secured, the family is safe, and a digital evidence package is being compiled for the FBI's cybercrime division. This isn't just insurance anymore. It's a private security subscription. It's roadside assistance for the digital age. The monthly premium the Millers pay isn't just a bet against a future accident. It's a retainer for an on-demand, elite cybersecurity squad. This is the only model that makes sense in a world of connected, autonomous vehicles. And the companies pioneering this are not emerging from the hallowed halls of traditional insurance firms in Hartford or Des Moines. They're coming out of Silicon Valley, Tel Aviv, and other global tech hubs. They're founded by former white-hat hackers and national security experts who understand that the biggest risk on the road is no longer the nut behind the wheel, but the ghost in the machine. The systemic risk is staggering. Imagine a coordinated attack that doesn't just target one family, but an entire fleet of autonomous trucks carrying goods across the country. A hacker could halt a significant portion of the nation's supply chain with a few keystrokes, demanding a multi-billion-dollar ransom. Or what if they target all the vehicles from a single manufacturer in a major city like Los Angeles or Chicago during rush hour, simultaneously disabling them all? The resulting gridlock wouldn't just be an inconvenience. It would be a national economic and security crisis. This is why the future of auto insurance has to be proactive, not reactive. It can't just be about paying for the damage after it's done. It has to be about preventing the damage in the first place. Companies are already building frameworks for this. They're creating what's called parametric insurance. Instead of a long, drawn-out claims process, these policies are based on a trigger. For example, if a federal agency like CISA, the Cybersecurity and Infrastructure Security Agency, confirms a specific named cyberattack has compromised a certain vehicle model, the policy pays out automatically. No adjusters, no arguments. The trigger is met, the payment is released. This provides businesses and individuals with the rapid liquidity they need to recover from a widespread digital catastrophe. The old guard is slowly waking up to this reality. You're seeing major insurers ink partnerships with cybersecurity firms, trying to bolt on these capabilities to their existing, aging frameworks. But the startups, the ones built from the ground up with a digital-first, security-first mindset, are the ones truly defining this new frontier. They are the ones to watch, because they understand a fundamental truth that the rest of the industry is just beginning to grasp. The most important safety feature in a modern car isn't the airbag or the anti-lock brakes. It's the firewall. And protecting that firewall is the future of keeping us safe on the road. But this digital transformation of risk brings up an even more profound question. As our cars become smarter, more connected, and more capable of driving themselves, the data they generate points to one unavoidable conclusion: that the human driver is being written out of the equation. For over a century, the entire auto insurance industry has been built on a single foundational premise. 94% of all accidents are caused by human error. Your mistake. My mistake. Someone texting, someone speeding, someone falling asleep at the wheel. We, the fallible, unpredictable humans, have always been the primary variable of risk. Our age, our driving record, our zip code, our credit score, it was all a proxy for trying to predict our behavior. But what happens when the primary driver is no longer a person but a piece of software? What happens when the entity making the split-second life or death decisions is a network of sensors and algorithms? This isn't a distant science fiction future. This is happening right now in slow motion on highways all across America. Cars with Level 2 and Level 3 autonomous features are already here. And with them comes a legal and financial reckoning that is shaking the insurance world to its core. Imagine this scenario. You're on the interstate, your car's advanced driver assist system is engaged. You're supervising as the manual tells you to, but the car is handling the steering, braking, and acceleration. Suddenly, the car in front of you blows a tire, swerves violently, and your car, despite its array of sophisticated sensors, fails to react in time. Collides with the other vehicle. Who is at fault? Think about that for a second. In the old world, it was simple. Insurance companies would argue about following distance, reaction time, maybe distracted driving. But now, did you, the supervisor, fail in your duty to intervene? Or did the multi-billion-dollar autonomous system, advertised as being safer than a human, fail to perform its function? How do you even begin to prove it? The critical data, the sensor readings, the software's decision-making process. It's all locked away inside the car's computer. A digital black box owned and understood by only one entity, the car manufacturer. This single question, who is at fault, is creating a new Grand Canyon in the insurance landscape. And into that canyon are stepping the last companies you'd ever expect to see selling insurance policies, the automakers themselves. This is the next massive disruption, and the company at the bleeding edge of this transformation is, unsurprisingly, Tesla. Tesla Insurance is not just another side hustle for Elon Musk. It is a calculated strategic move based on one undeniable advantage: data. A traditional insurer like State Farm or Geico has to guess how risky you are. Tesla knows. It knows every time you accelerate harshly, brake too hard, or take a corner too fast. It knows how often you use autopilot and, more importantly, how well you use it. It knows when the system disengages, when you get a forward collision warning you didn't react to. They possess a granular, second-by-second understanding of the vehicle's performance and the driver's behavior that traditional insurers can only dream of. And they're using this data to create a fundamentally different kind of insurance. Instead of a static premium based on your demographic profile, Tesla offers a dynamic, real-time safety score. This score, updated daily, directly impacts your monthly premium. Drive safely, let autopilot handle the boring parts of a commute, and you could see your insurance costs plummet. Drive like a maniac and you'll pay the price, literally. It's the ultimate evolution of usage-based insurance, because the insurer is also the creator of the machine. They're not just insuring a driver, they're ensuring a human-machine partnership. And this is where it gets truly revolutionary. In that accident scenario we talked about, if you have Tesla insurance, the entire conflict changes. You're no longer caught in a three-way legal battle between yourself, a giant insurance company, and a giant car manufacturer. The car maker and the insurer are one and the same. They have all the data. In theory, this should lead to a faster, more streamlined claims process. They can analyze the car's logs and determine almost instantly whether it was a system failure or human error. This vertical integration of manufacturing, software, and insurance is a paradigm shift. But don't think for a moment this is just a Tesla phenomenon. This is the direction the entire industry is headed. General Motors has OnStar Insurance, which leverages its own telematics data from millions of GM vehicles. They know if you're a safe driver in your Chevy Bolt before you even apply for a quote. Ford has its own partnerships, using its Ford Pass and Lincoln Way apps to gather data and offer usage-based policies. Rivian, the electric truck startup, launched its own insurance product from day one, bundling it with the vehicle purchase and using the truck's technology to underwrite the policy. What we're witnessing is the birth of the OEM insurer, the original equipment manufacturer as the insurance provider. And it makes perfect sense. Who understands the risk of a Ford F-150 with Blue Cruise better than Ford? Who knows the intricate details of a Cadillac Super Cruise system better than GM? They designed the hardware. They wrote the software. They are in the best possible position to price the risk associated with their own creation. For consumers, this new world offers a tantalizing promise. The promise of fairness. Why should a safe, attentive driver who properly uses their car's advanced safety features pay the same rate as someone who recklessly ignores them? With manufacturer-led insurance, your premium is a direct reflection of your synergy with the vehicle. It also promises lower costs. By cutting out the middleman, the traditional insurance carrier, and using their data advantage, automakers believe they can offer more competitive rates, especially for their safest customers. But this brave new world also has a darker side. It raises profound questions about privacy and control. Your car manufacturer could soon know more about your daily habits than your spouse. They'll know you leave for work at 7:15 a.m., that you always stop for coffee at the same place, and that you tend to speed on that one empty stretch of road on your way home. What happens to that data? How is it protected? And what about choice? If the best, most affordable insurance for your new Ford is only available through Ford, you're effectively locked into their ecosystem. This reduces competition. What happens if you have a legitimate claim, but the manufacturer, who is now also your insurer, denies it based on proprietary data from the car's black box that you're not allowed to see? You would be forced to sue the very company that holds all the evidence. It creates a massive power imbalance, turning your relationship with your car company into one of complete dependency. This is the tightrope we're all about to walk. The shift from insuring the driver to insuring the vehicle's system is inevitable. The rise of the automaker as the insurer is already happening. Companies like Tesla, GM, and Ford are no longer just car companies. They are rapidly becoming data and insurance powerhouses. They are redefining the very meaning of auto insurance before our eyes, turning it from a game of statistical guesswork into a science of absolute certainty. But as these legacy titans of manufacturing pivot to dominate a new industry, it begs the most important question of all for the $100 billion companies we've known for decades. What happens to Geico, Progressive, and Allstate when the very machines they've built their empires on start insuring themselves? It's a terrifying thought for a boardroom in Hartford, Connecticut, or Mayfield Village, Ohio. Because the future isn't just about a new company with a better app. The future is about a fundamental rewiring of the entire concept of risk. For 100 years, insurance has been a guess. A highly educated, statistically backed, actuarially sound guess, but a guess nonetheless. They guessed your risk based on your age, your zip code, your credit score, the car you drove. They were betting on proxies for behavior. But what happens when you no longer have to guess? What happens when you have the data? Not a proxy for it. The actual raw, undeniable data of every second of every drive. This isn't a disruption. This is an extinction-level event. The giants hear the thunder. They see the sky darkening. They are not stupid. Progressive, for its part, saw this coming over a decade ago with Snapshot. They were the first major player to say, "Hey, maybe we should actually see how you drive." It was clunky. It was a weird little device you plugged into your car's OBD2 port that beeped at you if you braked too hard. Most people saw it as a gimmick, a way to maybe save a few bucks. But what it really was a desperate first attempt to bridge the gap between the old world and the new. It was Progressive trying to learn a new language, and all they could manage were a few broken phrases. They were collecting telematics data, yes, but they were still feeding it into an old machine, a machine built to think in terms of credit scores and marital status. They had a V8 engine, but they were trying to power a horse-drawn carriage. Allstate took a different and arguably more cunning approach. They saw the data tsunami coming and decided that instead of just trying to surf it, they would build the dam and sell the electricity. They created a subsidiary called Arity in 2016. Most people have never heard of it, and that's by design. Arity isn't an insurance company. It's a data company. They collect driving data from millions of sources. Not just Allstate customers, but from other apps and devices that people use every day. They then analyze this massive fire hose of information to create a driving score for nearly every person on the road. And then, they sell that data. They sell it to other insurance companies, to city planners, to anyone who wants to understand how America moves. It's a brilliant, if slightly dystopian, hedge. Allstate is essentially saying, if the old way of calculating risk dies, we'll be the ones selling the shovels for the new gold rush. We will own the data that powers our competitors. And Geico? The gecko, for all its charm, is the face of an institution struggling with a classic innovator's dilemma. Their entire business model, their multi-billion-dollar advertising spend, is built on a simple promise. 15 minutes could save you 15% or more on car insurance. That promise is based on the old world of averages and demographics. It's a volume game. Get as many people as possible into the top of the funnel, sort them into broad risk pools, and play the odds. How do you pivot that behemoth, that finely tuned machine for acquiring customers the old-fashioned way, to a new model that says, forget the 15-minute quote. Let us watch you for 30 days and we'll give you a price that is uniquely, individually yours? It's like trying to turn an aircraft carrier on a dime. They have legacy computer systems, mainframes that might have been state-of-the-art in the 1990s, but are now digital fossils. They have tens of thousands of employees and a corporate culture built around a century of established practice. They are spending billions trying to modernize, creating Geico tech hubs and hiring data scientists from Silicon Valley. But they are bolting a jet engine onto a steamship. The underlying architecture, the very foundation of how they think about a customer, is from a different era. The new companies like Root and ClearCover are building from scratch on the cloud. Their data isn't trapped in siloed, ancient databases. It's fluid. It's real-time. They can ask a question and get an answer in seconds. For a legacy insurer, that same question might require a team of analysts to spend weeks pulling reports from 3 different departments. By the time they have the answer, the market has already moved on. But here is the great, unspoken advantage the old guard still has: inertia. And America. The simple fact is, the average car on the road in the United States is over 12 years old. It doesn't have a built-in cellular connection. It doesn't have a sophisticated computer monitoring every turn and brake. It's just a car. For the tens of millions of people driving a 2010 Toyota Camry or a 2014 Ford F-150, the promise of usage-based insurance is a fiction. They can't participate. And for these people, the familiar jingle of Nationwide is on your side, or the comforting presence of a local State Farm agent is powerful. The legacy insurers are the kings of this vast, slow-to-change market. They are the default option. They have brand recognition that the startups can only dream of, built on a century of baseball stadium sponsorships and Super Bowl commercials. They are a utility like the power company or the water department. You don't think about them much, you just pay the bill. This is their fortress. The new tech-based insurers are nibbling at the edges, picking off the early adopters, the Tesla owners, the tech-savvy millennials in urban centers. But the heartland, the vast majority of the driving public, still belongs to the old kings. For now. Because the battle isn't just about who can offer the cheapest rate to a 25-year-old with a perfect driving record and a new Honda Civic. The real war is a philosophical one. It's a war over the very definition of fairness. The old model says it's fair to charge someone more because they live in a crowded zip code, even if they're the safest driver in that zip code. It says it's fair to use a credit score as a proxy for responsibility, even if that person's financial struggles have nothing to do with their behavior behind the wheel. The new model rejects this entirely. It says the only thing that is fair, the only thing that matters is how you actually drive. It's a meritocracy of the road. This is a powerful, almost seductive idea. And as more and more cars roll off the assembly line with the built-in technology to make this idea a reality, the fortress walls of the old guard begin to look less like impenetrable stone and more like crumbling sand. They are fighting a two-front war. Against the nimble data-native startups on one side, and against their own crippling legacy infrastructure on the other. They have the customers, they have the capital, they have the brand, but they are playing a game where the rules are being rewritten live by their opponents. But even this titanic struggle, this clash between the old gods and the new, misses the true earthquake rumbling just beneath the surface. We've talked about new insurance companies and we've talked about the old ones trying to adapt, but we've overlooked the most powerful player in this entire equation. The one entity that has more data, more control, and more direct access to the customer than anyone else. The one that could, with a single software update, make this entire industry fight irrelevant. The car manufacturer itself. Think about it. Every other insurance company, from the 100-year-old giant to the buzzy startup, is trying to solve the same problem. How do we guess who is a good driver? They use proxies. Your age, your credit score, your zip code, even the data from your phone. But it's all an educated guess. They're standing outside the car, trying to figure out what's happening inside. The car manufacturer is already in the driver's seat. Literally. They don't need a proxy. They have the source code. This isn't a theoretical future. It's happening right now. And the poster child for this revolution is, unsurprisingly, Tesla. When Tesla launched its own insurance product, the industry sort of rolled its eyes. They saw it as a gimmick, a little side project for a quirky car company. They were dead wrong. Tesla insurance isn't just another policy. It's a fundamental reimagining of how risk is calculated. Every Tesla is a rolling supercomputer, packed with sensors, cameras, and a constant connection to the mothership. It already collects an insane amount of data to make its autopilot system work. So, Tesla decided to use that same data to price insurance. They created something called a safety score. It's a number from 0 to 100, calculated in real time, based on your actual driving behavior as measured directly by the car. It doesn't care about your credit score. It doesn't care if you're 21 or 61. It cares about 5 specific things. 1. How many forward collision warnings you get per 1,000 miles. That's the car beeping at you because it thinks you're about to rear-end someone. 2. Heartbreaking. Are you slamming on the brakes? Or are you driving smoothly and anticipating traffic? 3. Aggressive turning. Are you taking corners like you're on a racetrack? 4. Unsafe following distance. The car knows exactly how close you are to the vehicle in front of you and for how long. And 5. Forced autopilot disengagement. That's when the system decides you're not paying attention and shuts off. Based on your score in these 5 areas, Tesla calculates your monthly premium. A driver with a safety score of 98 might pay a third of what a driver with a score of 85 pays. This is the holy grail of usage-based insurance. It's not a guess based on your phone's accelerometer. It's a precise measurement from the vehicle's integrated systems. And here's the genius part. It creates a direct feedback loop. You can see your safety score in the Tesla app. You can see exactly what you did that lowered it. Did you follow too closely on the freeway yesterday? The data is right there. It gamifies safe driving. People become obsessed with getting their score to 100 not just to save money but for the challenge. In doing so, they become safer drivers, which reduces accidents, which reduces claims for Tesla, which allows them to offer even lower rates. It's a virtuous cycle that legacy insurers can only dream of. Now, of course, it's not perfect. People complain that the system is too sensitive. You get cut off by another car, you're forced to slam on the brakes, and your score takes a hit. Feels unfair. And the privacy implications are enormous. This company knows every turn you make, every acceleration, every braking event. For many, that's a bridge too far. But the competitive advantage is undeniable. Geico can't do this. Progressive can't do this. They can give you a dongle to plug into your car's OBD2 port, like Progressive Snapshot, or ask you to use an app on your phone like Root. But that's a clumsy workaround. The dongle can't access the car's advanced safety systems. The phone app doesn't know if you're the driver or the passenger. It's an approximation. Tesla has the ground truth, and they don't have to ask you to install a thing. The hardware is already built into the product you bought. This is the moat. The car manufacturer is the only entity that can seamlessly integrate the insurance product with the vehicle itself. And don't think for a second that the other automakers haven't noticed. General Motors has been on this path for years. They have OnStar, which has been putting connected hardware in cars for over 2 decades. In 2021, they launched OnStar Insurance. They have driving data for millions of GM vehicles, Chevys, Buicks, Cadillacs stretching back years. They can offer a discount right at the dealership when you buy a new car, based on the safety features of that specific vehicle and, with your permission, your past driving behavior in your old GM car. It's frictionless. Ford is doing the same with its Ford Insure and Lincoln Insure programs, leveraging the built-in modems in their newer vehicles. Rivian, the electric truck startup, has its own insurance product that it can perfectly tailor to the unique risks of off-roading and adventuring. Stellantis, the parent company of Chrysler, Dodge, and Jeep, has created a whole division called Mobilisites just to manage and monetize the data flowing from its millions of connected cars, with insurance being a key target. The legacy insurance industry is in a vice grip. On one side, you have the agile Insurtechs like Root and Metromile, chipping away at their customer base with slick apps and usage-based models. But on the other, more powerful side, you have the automakers who are threatening to cut them out of the loop entirely. Why would a customer go to an outside insurer when they can get a cheaper, more accurate, perfectly integrated policy directly from the company that made their car? The dealership becomes the new insurance agency. This leads us to the ultimate endgame, the final step in this evolution. As cars become more and more autonomous, the entire concept of risk begins to shift. Right now, insurance is based on the driver. Over 90% of accidents are caused by human error. But what happens when the human isn't the one driving? When you're in a level 4 autonomous vehicle on the highway, and it gets into an accident, whose fault is it? Is it yours? You were just sitting there watching a movie. Is it the other driver's? Or is it a bug in the software that controls your car? The risk is no longer about the driver's behavior. It's about the vehicle's performance. And who is in the best position to underwrite the risk of a software failure? The company that wrote the software. The company that designed the hardware. The manufacturer. In this future, your car insurance might look less like a Geico policy and more like Apple Care. It might be a subscription you pay directly to Ford or GM or Tesla to guarantee the performance and safety of their autonomous system. The liability shifts from the individual to the corporation. So when we ask, what are the new auto insurance companies to watch out for? The answer is far more radical than we thought at the start of this journey. It's not just about a better app or a clever marketing campaign. It's about who owns the data and who owns the customer relationship. The companies to watch are the ones whose names are on the back of your car. Tesla, General Motors, Ford, Rivian, and every other automaker scrambling to become a technology company. They are building a future where insurance is not an afterthought, a grudge purchase you're forced to make, but a native integrated feature of the vehicle itself. A future where your car's software actively coaches you to be a better driver, rewarding you instantly with lower premiums. And eventually, a future where the car insures itself. The revolution in the auto insurance industry isn't some distant storm on the horizon. The ground is already shaking. The next time you shop for a policy, your best quote might not come from a friendly gecko or a perky saleswoman in a white apron. It might just be an option you check on a screen when you order your next car. The most disruptive new auto insurance company in America might just be the one that's already parked in your driveway.